Carvana offers an online platform where customers can buy and sell used cars. After flirting with bankruptcy in 2022, shares have recovered and are now up 240% over the past year. But can the stock continue its powerful run? At the latest price, Carvana now has a market cap of $76.2 billion. Account for cash, debt and non-controlling interests, and the company's full enterprise value is over $80 billion. Revenue over the last 12 months comes to $14.8 billion, with $398 million of net income and $949 million of free cash flow. So the company is valued at over 100 times earnings and 85 times free cash flow. That seems expensive for an auto dealership. But the auto industry is a large market that is ripe for disruption. Carvana likes to position itself as an e-commerce business. The company buys vehicles, reconditions them, and then sells them on to customers online. They offer financing, delivery, returns, and a head-turning vending machine for customer pickups. But the company also functions as a lender, offering consumer auto loans, which it then sells to investors like Ali Financial. And right now, things are going well. Revenues have grown 32% over the past year, with net income and free cash flow turning positive. The 2022 cash crunch, which saw the company cut costs and restructure its debt, is now in the rearview mirror. But not everyone is bullish on Carvana, with short sellers Hindenburg Research and Jim Chanos both flagging some serious concerns. Shorts argue that Carvana isn't as profitable as it looks. Nearly all of Carvana's net income comes not from selling cars, but the selling of loans to third parties, many of which are subprime loans. These loans are packaged up to reduce risk, but if they underperform, banks like Ali Financial could stop buying them, and that would cause Carvana's business model to unravel again. There are also concerns of loans being sold to undisclosed parties and the offloading of liabilities to auto retailer DriveTime, which is a private company owned by the CEO's father. A lack of transparency on these transactions makes it hard for investors to analyze Carvana's underwriting. Meanwhile, investors must remember that the auto industry is highly cyclical. A weak economy or rising loan delinquencies could push Carvana back into the red, leading to a vicious cycle similar to the one seen in 2022. And all of this is happening while the company trades at a sky-high valuation with huge amounts of insider selling. Last week alone, insiders sold roughly $90 million worth of stock, a pattern that occurred before the previous market drop. In other words, Carvana is not a straightforward investment. Despite the opportunity of disruption, the stock looks too richly valued given the modest net income, insider sales, and the cyclical nature of the industry. But these are my personal opinions, not financial advice, and I currently hold no position in Carvana. For more investing ideas, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.